In this video, we will talk about the application of the RSI indicator for trading stocks. The Relative Strength Index, RSI, is a popular momentum oscillator used by traders and investors to identify overbought and oversold levels in stocks and other financial instruments. It ranges from 0 to 100 and measures the speed and change of price movements. Oscillators typically perform well in markets that lock in trading ranges instead of setting long-term trends. This is why using RSI for stocks can be tricky, as stocks often maintain trends for extended periods. Therefore, using RSI blindly, or without other technical indicators, for stocks may likely result in losses rather than gains. This video doesn't provide any kind of investment or trading advice. Instead, it presents only educational material to help you understand the RSI. What is the RSI indicator? The Relative Strength Index RSI is a widely used momentum oscillator for stock trading technical analysis. It was created by Welles Wilder in June 1978, who detailed its calculation method in his book New Concepts in Technical Trading Systems. This type of oscillator is a technical analysis tool that measures the speed and amount of price changes in a financial instrument. It compares the average gains and losses of a security over a certain period, helping you determine the asset's strength and weakness. You obtain the relative strength RS by dividing the average number of up closes over a span of X days by the average number of down closes over the same X day period. Welles Wilder popularized the use of the 14-day RSI, which is widely adopted. However, you still have the flexibility to choose the number of days for the computation. Basics behind the RSI indicator. The RSI indicator oscillates between 0 and 100. Generally, an RSI reading above 70 suggests that a stock is overbought. This means it is potentially due for a pullback. On the other hand, an RSI reading below 30 on the price chart suggests that a stock is oversold. This means it is potentially due for a rebound. The moment when the RSI crosses a 70 or 20 watermark, you might consider it a trading signal. However, don't rely solely on such a signal to build your trade. Using divergence may help you get a clearer picture and a better signal. Divergence is a confirmed signal, meaning it is stronger than a usual RSI signal when it crosses the oversold area threshold, for example. Divergence, therefore, is more reliable and produces a better hit rate. However, it appears divergence in the Relative Strength Index RSI is a powerful concept in technical analysis that occurs when the price of an asset and the RSI indicator move in opposite directions. This non-confirmation between price action and momentum often signals a potential shift in the current trend strength. Types of RSI divergence. There are two main categories of RSI divergence, each with a regular and a hidden form. Regular divergence, trend reversal signal. Bullish divergence occurs in a downtrend. The asset's price makes a lower low, but the RSI makes a higher low. This suggests that despite the falling price, the selling momentum is weakening, signaling a possible upward trend reversal. Bearish divergence occurs in an uptrend. The asset's price makes a higher high, but the RSI makes a lower high. This suggests that the buying momentum is fading, signaling a possible downward trend reversal. Hidden divergence, trend continuation signal. Hidden bullish divergence, seen in an uptrend during a pullback. The price makes a higher low, but the RSI makes a lower low. This reinforces the strength of the existing uptrend, indicating the pullback is likely over and the trend will continue upward. Hidden bearish divergence, seen in a downtrend during a rally. The price makes a lower high, but the RSI makes a higher high. This suggests the prevailing downtrend is likely to continue after the minor rally is complete. Traders use divergence as an early warning sign to anticipate market changes, often confirming the signals with other indicators, chart patterns, and trading on higher time frames for greater reliability. Using classic RSI indicator signals for stocks. Let's take a look at a backtest of a trading system based on the RSI indicator in an application for APL Apple stock captured from the TradingView community. In this particular case, the strategy is to keep a position open until it generates a signal in the opposite direction. When you apply the RSI in its simplest form, buy when the RSI escapes the overbought area and sell when it moves away from the oversold area it produces, a similar result across all timeframes, a pretty consistent loss. Using divergence for RSI in trading, you achieve better results when you use bullish divergence or bearish divergence. When the RSI indicator value remains in overbought territory for a long time, you should probably avoid short signals or apply additional confirmation to them, while favoring long signals. The dominance of long signals helps you maintain positions in the direction of trends. In the example below, you'll see entry points generated not just in the oversold conditions or overbought areas. That might seem to break the traditional rules, but overbought, oversold prices rarely occur for most stocks. Consequently, the number of positions you trade might end up being very low. That is why sometimes you might accept signals even outside those areas. Confirmation of RSI signals for trading. You can use the RSI indicator as a guide for possible trades, as that is how it is often used, and not as a strict rule for entry. To pinpoint your entry when starting a trade, you can use a confirmation. For example, a candlestick pattern, such as an engulfing pattern, could indicate the acceleration of momentum. Here's how to use a simple engulfing pattern on a candlestick chart within an H1 timeframe to confirm when to enter a trade. Rather than starting a trade as soon as the RSI gives a signal, you might want to wait for a more dependable pattern to show up and then make your decision to take possible action. Best RSI settings for short-term trading styles. According to statistics, short-term trading styles usually work best with settings for RSI between 20 and 50. Avoid using parameters lower than 10 as your RSI indicators may become too sensitive, incorrectly signaling overbought or oversold market conditions. However, always test these settings with your specific trading instrument to ensure they're effective. Best RSI settings for long-term trading styles. As a long-term trader, using a parameter of 50 for RSI can help you avoid overtrading. It's also beneficial to apply this to longer timeframes like daily charts. Remember to define the correct parameter through a backtest. Professional traders rarely change the parameters of their indicators to avoid overfitting. For long-term trading, you can use daily or weekly timeframe. Pros and cons of using the RSI indicator for trading. In this section of video, we dive into the strengths and weaknesses of using the Relative Strength Index RSI for stock trading. On the plus side, this technical analysis tool can help identify good entry points and produce a high win rate while being relatively simple to use. However, it's not perfect. It can often produce false signals. It may not add additional insights beyond price and volume, and its effectiveness can vary across different timeframes. Advantages of the RSI indicator in Forex and stock trading. Stocks often establish long-term bullish trends. The RSI indicator can help Disadvantages of the RSI indicator in Forex and stock trading. RSI does not work well when it comes to extended trends, and the stock market is known for extended bullish trends. For example, RSI may produce a lot of false counter-trend signals if applied to an actively growing stock. RSI is just an indicator, meaning that it is a derivative of the price. If you are a beginner trader, it may help you organize the data, but it can't add anything specifically new to guide your decision-making other than price combined with volume. RSI works with mean reversion signals, which means that it can help a trade to catch the top or bottom of the price action. Mean reversion strategies are not perfect and may produce losses if the stock price quickly breaks or continues moving in one direction, especially with gaps. RSI is not very sensitive to price action. It may give you signals too early. RSI strategies may perform differently across different timeframes, so you must apply in-depth research before using them. Best strategy for using RSI indicator. The Relative Strength Index, RSI, is a momentum oscillator used to identify overbought or oversold conditions. The most effective strategy involves using it in conjunction with trend analysis and confirmation signals. Trend confirmation. The RSI performs best when the market is trending. During an uptrend, treat the 30 level as a buying opportunity oversold, and use the 70 level overbought to take profits, not necessarily to short. In a downtrend, treat the 70 level as a selling opportunity, and use the 30 level for profit taking. Divergence. A powerful signal occurs when the price makes a lower low, but the RSI makes a higher low bullish divergence, or vice versa bearish divergence. This suggests the current trend is losing momentum and a reversal is likely. Setup. Use the default 14-period setting. Look for the RSI to move from oversold below 30 back above 30 to confirm a buy, or from overbought above 70 back below 70 to confirm a sell. Note: always combine the RSI with other tools like support and resistance, moving averages, or price action for stronger entry/exit points. Avoid using RSI alone in sideways or choppy markets. Would you like to know more about how to combine RSI with a specific market? The best indicator to combine with the Relative Strength Index RSI is the Moving Average Convergence-Divergence market. This combination is powerful because the two indicators measure momentum using fundamentally different approaches, allowing them to confirm each other's signals and reduce false positives. RSI's role oscillator. The RSI is a leading oscillator that measures the speed and change of price movements, primarily to identify overbought above 70 and oversold below 30 conditions. MACD's role. Trend following. The MACD is a lagging trend following indicator that measures the relationship between two exponential moving averages EMAs, giving insight into trend strength and direction. Combined strategy. Entry confirmation by signal. Look for the RSI to move up from the oversold region below 30 whilst the MACD line simultaneously performs a bullish crossover crossing above its signal line. This double confirmation is a strong buy signal. Exit. Short confirmation. Sell signal. Look for the RSI to move down from the overbought region above 70 whilst the MACD line simultaneously performs a bearish crossover crossing below its signal line. This suggests a strong sell opportunity. By pairing the RSI's insight into price exhaustion with the MACD's view on trend momentum, you create a more reliable and robust trading system. Which timeframe is best for C indicator? Generally, RSI is designed for operating on short-term to medium-term timeframes, such as hourly charts, 30-minute charts, and 4-hour charts. While there are no limitations to the usage of this indicator, a trader should remember that the higher the time frame, the more trendy the market potentially is. RSI indicator works better at identifying short-term overbought or oversold market conditions, which means operating in a trading range. Higher timeframes, such as D1, produce less rotation and more momentum. That's why using a momentum indicator would be preferable for higher timeframes. On the other hand, trading strategies for RSI built for extremely small timeframes, such as 1-minute or 5-minute charts, are also questionable. As the profit potential for any RSI signals would be too small, traders may end up generating a lot of trading costs with a limited result. So, the best niche for RSI is probably medium-term timeframes between M15 and H4.